Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for January 7th of 2024. Well, Happy New Year to all of you. Welcome to 2024. Good to be with you. I hope all of you had a wonderful holiday with safe travel and time with family and friends. As we get started in the new year and the new week and the first chart pack of the year, want to kind of retrain ourselves on some of the things that we've been paying attention to for the last several months, some of the things that are going to be germane to the investment landscape over at least the first half of the year, and things that I think are interesting enough that we should, certainly pay attention to. And obviously the first, and not the least of which, is geopolitical tensions. We've seen, with the Hamas attack in Gaza in October, that certainly persists. That is relatively new to this chart. We still have the Ukraine war. China trade dispute and tensions with China, I think, are going to linger for some time. We've seen some negative economic data and economic trends in general out of China, which potentially might make them a little bit more belligerent, perhaps, but also in other respects, maybe a little bit more confined in how they can assert themselves on the global stage. But COVID continues to kind of recede into the national calculus, even though the pandemic, it's not a pandemic anymore, but even though COVID still persists in its various waves and people are still getting it. But in any case, we start this year, don't want to overemphasize geopolitics because it oftentimes is shadowed by other, fairly important direct economic issues that help drive economic markets. But I thought we'd start here. Obviously there are quite a few things on the plate. In keeping with the initial slide here on geopolitical tensions, this is something with real economic impacts, and we haven't really seen it manifest yet. I'm not sure to what degree we will, but what you see here is a map of Europe, Asia, and Africa with the circle indicating the Red Sea. And so we just mentioned the Gazan conflict being a relatively new phenomenon, certainly relative to the Ukraine conflict, et cetera. And so what we're seeing now are basically Iranian-backed proxies trying to assert themselves on the, at least in the regional sphere. And so they've disrupted a lot of traffic. You probably have read about the attacks on commercial vessels, and they're being fairly indiscriminate on who they are attacking. And of course, the U.S. and some other allies have, brought military presence to the region. But what it is doing is it's causing a mass amount of diversions. And you can see here very clearly, in this chart where, you have, the Red Sea right here and very little traffic. And you see a lot of this being diverted around the Cape of Good Hope. And we already know that you don't see the U.S. in this or Central America, but we do know that there has been a drought in Central America, which is reduced volumes to a great degree in the Panama Canal. So something that we are watching is clearly, I believe the numbers somewhere around 15 to 20% of all world trade and container volume goes through the Red Sea here, and about 8% goes through the Panama Canal. So this is kind of a big deal that we need to watch. So now we'll go ahead and pivot into some economic data. And first, I want to look a little bit inward, recognizing that some of you are not in Texas or in the Southwest area. So apologies to you on that. But I think this is relevant in some sense here, since most of you are in the Southwest and Texas region. But here we have data on real GDP growth for Texas versus the rest of the country. And so we know that Texas itself is probably the 8th largest economy in the world. And so what's clear in this slide is there are pockets of the U.S. that are doing better than others. And we talked about kind of a lingering manufacturing recession. And in some areas of the country, we've talked about net migration a lot into certain areas. Certainly the Southwest is one. But we see here, Texas in the blue lines, looking at quarterly data, third quarter GDP for the state of Texas was 7.7 versus 4.9 for the rest of the U.S. Again, this year, at least in the first half, we're looking for a little bit slower growth, but there are clearly pockets of strength around, and Texas is one of them. On this slide, we have real disposable income growth. This is a global view, so you've got multiple geographies represented here. U.S. is in blue. You can see entering into 2024 where the consensus is, at least with regard to Goldman Sachs, perhaps not a consensus, but at least Goldman's view is that we're going to have positive real disposable income growth for basically the bulk of the globe, looking out into the next several years. And when you look at it on its face, and as I've been talking about, it's certainly in the U.S. Income growth leads to consumption. Consumption represents 2/3 to 70% of our domestic economy. It's very important, but as we're going to see in a Dallas Fed, some charts from the Dallas Fed coming up, that it's not necessarily trends in consumption that are as important as investment. But nevertheless, it is really positive to see as we head into the new year, income growth expectations are still relatively positive across the globe. We have a chart here from Deutsche Bank. Americans spending more despite being less confident. And it's kind of an interesting dynamic when you think about consumer confidence, consumer expectations. We have surveys for that. Sometimes in the case of consumer expectations, University of Michigan survey, it depends a lot on what your inflation expectations are. But in other respects, it depends things as simple as gasoline prices. But what we see here is real disposable consumption expenditures, real PCE. It's an important data point for the Fed. That continues to plow right ahead. But then we've got the Michigan consumer sentiment indicators, which usually correlate reasonably well. At least they have over the last decade or so, up until the pandemic, have really broken ranks here. And so this is a dichotomy that I think it'd be interesting to watch, that you have confidence relatively low, but spending, it remains high. And then on the right-hand side may give you a little bit of insight into demographics. You can see here that the Gen X and millennials, and to some degree baby boomers, the credit card debt that's outstanding is really mainly attributable to those folks, with Gen X representing the lion's share, and also I think to some degree representing a large part of that growth actually over the last couple of years. I want to turn your attention now to a bit of research that I got from the Dallas Fed. And this is one of 3 different charts that I'm going to show you from that research piece, which I thought were particularly insightful because, we talk a lot about consumption, how important it is to economic growth, and it is important to economic growth. But what their research says, you go back into these little vignettes in time here in these inflection points where we enter recession. And oddly enough, you have positive contribution from consumption leading into a recession. You see some of that depicted in green here. It's not, sometimes it dovetails, but oftentimes it does not. But the real driver is private fixed investment. And say, private fixed investment in general, and in many cases residential investment, is really important to the path to get to recession. And so as we talk a lot and have about the risk of recession in 2024, and the fact that it was kind of pushed out, that we thought we were going to get some slowness last year, and the fact that we had such strong consumer spending, labor market, wages, so on and so forth, that it didn't happen. And we start to worry about, okay, is this going to happen in 2024? This research tells us that we should be paying a lot closer attention to private investment, fixed investment. This would be homes, this would be structures, this would be a lot of different things. And as you're going to see here in the ensuing charts and in the real-time data, that we're not in bad shape. Here we have, again, some vignettes in time where we can see here very clearly that real GDP growth heading into a recession, you see that's generally positive. So that's one thing as we exited a quarter in which we had pretty strong economic growth. And probably a little bit less so in the fourth quarter, but we won't get that data here for another few weeks, at least the initial reading. But you can see that data is generally pretty strong before it weakens. But you can see the contribution of personal consumption expenditures. I mean, that's basically consumption right there. And you can see that is in green. And I think this is the most telling chart in this research piece is that, heading into a recession, you've got strong consumption that helps to drive relatively reasonably or relatively decent overall economic growth. But in the blue here, you can see what anchors that. Maybe this is the foreshadowing is in that private fixed investment. And if you scroll over to 2023 on the right, you can see very clearly that that was positive to the tune of 0.6% year over year. And so we don't have that right now. We have positive private fixed investment alongside consumption, and that's driving economic growth. And that's very inconsistent when you look at the body of evidence in prior recessions and prior downturns, that's just simply not the case right now. Here we have the last chart from that research. I thought it was really important to show this here, that in the blue, you've got the contribution of non-residential investment to GDP. And then in the kind of the beige color there, you've got contribution of residential investment to GDP, and these are both in the quarters heading into a recession. And so you see all of the anecdotal data. These are the same time periods that we were looking at on the prior two charts. Here's a historical average of all of these different data periods that you typically are anchored by residential investment. That's really kind of that foreshadowing indicator. You have commercial and non-residential growth, but you're anchored by residential growth. Well, in 2023, guess what? That wasn't the case. In fact, I think we can make a very strong argument that residential investment is moving higher because of the lack of supply, well, just on its basis, a lack of affordability in the market, still, relatively speaking, even though mortgage rates have come down a little bit, but a lack of supply in new homes is driving a lot of construction. And, we just don't see that driver that correlates very heavily towards, pre-recessionary, instances here in the past. Now we'll look at some of the data that we actually see. Here's private construction spending. We're first going to look at the commercial sector, which we know is important, but we know that residential is very important as well. So here's manufacturing. We've got the CHIPS Act. We have stimulus to help drive semiconductor manufacturing in the U.S. You see that manufacturing line really moving higher. Non-residential, excluding manufacturing, is a little bit less so, but still on a trend line basis, looking pretty strong here. And then we break out this manufacturing number over here. This is manufacturing construction spending. Say what you will, this, a lot of this is, related to semiconductor manufacturing, but it's a really positive sign. You see that trend line that kind of moves like this, and then we're probably an order of magnitude above that right now. Here we have overall breakout in the black line. We've got non-residential construction overall. And then here we have residential construction. And you can see that both of these, as you go back over a number of years, this trend line on this particular data series is probably more like this, very consistent there. And then certainly on the residential side, we've had a fairly strong breakout, and we had a little bit of a pullback, But this is also a very strong trend line. Again, not something that you would, according to the Dallas Fed research, would correlate really highly to, a pre-recessionary environment. And then finally, over here, we've got public construction, which is just going nuts right now. And also a good sign from the government spending sector, which is also a component of economic growth. Now we'll kind of look at two more slides here before we meander into another topic. We've got U.S. private construction spending. You can see, even multifamily, in a fairly linear way from 1995, you've got that growing. You've got single family homes, which I just mentioned, really strong. Again, this is not very consistent with a growth economy. And then you can see both on the multifamily and single family here, looking at it a different way. This is builders that are, focusing, where is their focus? And I think you could probably see here pretty clearly that it's single family, but it's just looking at these data series a little bit differently. We'll look at manufacturing. I mentioned at the outset that, we still do have a lingering manufacturing sector and, services remain reasonably strong. We just seen that consumption remains relatively strong. We've got some more slides on that. But, here we have, a manufacturing sector that is still, probably a year into what we'll call kind of a rolling recession. And then, core goods inflation has been trending down, and we expect that to kind of, even go into it's certainly been in disinflation. But, we expect that this is going to take a little while to work itself out. One of the things that I think that we have all noted, going back to the inflation topic is, early on the Fed said, oh, this is all transitory. Well, it turns out that a lot of it was. A lot of it wasn't, and that was our argument. But a lot of it was in the sense that supply chains and whatnot, impacted delivery times, which is in this blue line. Core goods inflation, peaked because of the delivery times and the supply chain choke points. But a lot of that has removed itself from the equation. Now, granted, percent year over year, we're still higher than where we want to be, but at least on delivery times, we've worked out those kinks in the system, and we should see better overall performance out of the manufacturing sector, certainly by the time we hit 2025. Here we have the ISM Institute for Supply Management, PMI, Purchasing Managers Index, New Orders Index, and remains soft, again, consistent with what I just said with regard to the, kind of this soft environment that we have. And, the survey number was still looking for something below 50, which represents, anything below 50 represents contraction. We actually got a number that was slightly worse than that. So the environment in manufacturing is still soft. Just another slide here to represent that. Here we have manufacturing output year over year. You can see that that has been consistently down for most of the last year, 2023. Talk about payrolls, talk about employment just for a second here. Charts that I think we should be cognizant of heading into the new year is, yes, the labor market is stronger than we ever would have thought it would be. But, looking at it consistently over a period of time, you can see the change in private payrolls going down. You got, U.S. non-farm payrolls, monthly change. You're seeing, positive growth in payroll. So this is not a catastrophic situation, but we are below trend line and we are in a decelerating mode in labor. Here's our unemployment rate. Obviously still, very close to these, multi-decade lows. Expecting that to move higher. Again, with the softening in labor, I think it's inevitable. But, it doesn't have to be catastrophic, to use that term again. And you've got, various houses on the street that are, forecasting, an uptick in this as we head into the latter parts of 2024. Again, if you believe that we're heading into a soft landing, an unemployment rate that moves from something, like 3.7 to 4.2 is not a Herculean jump. It's not indicative of an economy that's really, really struggling. It's just indicative of a labor market that's just slowing a little bit. And on this chart, we have basically job openings for global employers that have listings in the U.S. And to be consistent with the past two slides, this is representing a labor market that's still relatively strong. If we go back to, basically early 2020, and just forget about the pandemic here, but just like go look at January, which, nobody was talking about COVID at that point, really. And so here we were at 4 million listings, and we're still above that, even though we've been consistently coming down. So I think this dovetails really nicely with the last two charts on labor, which indicate, that the market's still relatively strong for labor, but it's just simply slowing down. This is a chart on port congestion, and you can see here that this is also moving in the right direction. Several slides before the labor slides here, we had a chart on the basically supply chain issues prompting a deceleration in manufacturers' inflation, and we can see that very clearly kind of depicted here in terms of the congestion. So again, it's an environment that we feel is continuing to work itself out. We have vacancy rates for U.S. industrial real estate. I do think in 2024 we're going to be talking a little bit about the issues that some commercial, we're going to be talking about mid-market banks that are lending and doing commercial and industrial lending to real estate investors that are going to have to roll that debt over, and it's going to lead to some choke points. It's going to lead to probably some defaults, some people doing forced liquidations, and this is what bankers are looking at. They're looking at vacancy rates for industrial real estate. If you go back to the pre-pandemic, they were about 4.5 to 5%, and we saw a fairly dramatic drop. Moving from 4.5, 5 to 2.5 to 3 is actually pretty tectonic, but those trends are now reversing, and so I do think we're going to see some stress in the commercial real estate market. I'm not necessarily sure that it's going to manifest itself in industrial real estate, but certainly in office. Talk about something that is, I think, going to be perhaps a bright spot. We do see durable goods, orders, at least in the consumer channel, looking relatively decent. Now here we have auto and light truck sales. We've had a noticeable uptick. We've had that decline for several years, and this is heavily explained by everything that we already know now about the pandemic. But and that trended down, but we're now seeing that move back up. And so, we talk about consumption, we talk about incomes, you talk about the wherewithal to purchase autos and light trucks. Then that market, that environment is still favorable, and so this market here should continue to show some health heading into the new year. We're going to talk about investment topics now. We've got the difference between the 30-year fixed mortgage and the 10-year Treasury yield, which is really interesting. So, we have seen mortgage rates come down quite a bit, actually, in a relatively short period of time. But the interesting thing is that, over a longer period of time, I think you tend to see, something that's more like this. So we still have a delta between these two that is a little bit higher than it probably should be. I think some of this is a reflection of maybe the fact that, feeling that rates are going to be moving down a little bit, perhaps, during 2024. Not quite sure, but interesting to watch nonetheless. So here we have Goldman's estimates on mortgage rates. They expect mortgage rates to fall to 6.3 by year end, which is not a huge stretch from where they are now. They were closer to 7.75. In some cases, we did see an 8 handle on mortgage rates in some areas, but high sevens was kind of like the average, and now we've moved down to below 7, 6.75, in some cases 6.5, depending on where you are. So 6.3 is not a huge stretch. Goldman. Again, this is just one investment firm out there. They're expecting some continuing decline in these rates to kind of reach that 6% level. And as I've said, people got really used to this and low mortgage rates, and then when they shot up like a cannon, and this is a fairly dramatic rise right here. It created a lot of shock value, and it really pinched the market. And what we see now is if rates move from here to here, people feel like that's a relative bargain. And I think that is going to be this mortgage rate regime is, I think, going to be, I guess what's the best way to say it, that it will become more ingrained in the normal thinking, if you will. And, people are going to, lament the fact there won't be as much regret that they didn't do anything back here. They're just going to say, hey, listen, my relative value set is in this range right here. And if I can get a rate that's maybe 5.5, I consider that to be a bargain. And I think that's kind of how that market, the housing market, is going to kind of reconcile the rate environment over the next year or two. We have rents. We talk about this a lot. We talk about rents and wages being the stickiest components of inflation. Very much is the case. We do see on the apartment side rent increase year over year. We actually have a decrease in apartments, single family homes on rent. Again, this is all kind of feeds into owner's equivalent rent. But when you look at housing affordability, there still is positive growth here. And we've actually seen just in housing prices a slight uptick. But when you think about multifamily, we've had a little bit of deceleration as we did back during the pandemic. Here we've got charts on crude and gas, natural gas. We've seen a reasonable amount of stress in some of the energy basket items over the last 6 months. Here on Brent crude, which again is not WTI, West Texas Intermediate, but we've seen a consistent downtick here, and we had a little bit of an uptick in December. But from a Brent standpoint, we're hovering, in the high 70s, and then, here's our moving average. This is a 50-day moving average, and you can see that has clearly moved down as well. Now on the natural gas side, and by the way, this is good. When you think about crack spreads and translating, crude into gasoline and distillates, this should portend lower overall gasoline prices because your input cost is muted. And I do think that probably, maybe it upticks a little bit, but I think we probably wind up staying away from some of these highs, barring a very material, unforeseen geopolitical event. On natural gas side, this is obviously a boon to people that use natural gas for their homes, for heating during the winter, etc. And we have seen an uptick off the low in natural gas, but overall, that commodity basket is still pretty favorable. This is a sentiment indicator, the American Association of Individual Investors, the AAII Bull Bear Spread. And so what this tells us is that investors are very bullish. And, I've shown this to you, at least once over the last month and a half. And what's really kind of frenetic about it is that we were at ultimate bear lows very few months ago, like 3 months ago. And that's totally reversed, and you've got a lot of optimism in the market, and that helps to spur more investment, more speculation. I think risk taking. Although we've seen early on here in the first handful of trading days in the new year, people kind of peeling out and taking profits in the Magnificent Seven kind of high flying stocks. And to that point, here we have the S&P 500 mapped against the S&P 500 if you back out all of those AI stocks, the Magnificent Seven. So, we had a good year in the S&P 500. The equal weight was really struggling for a point. This is not quite the equal weight, but this is just basically taking out those AI stocks, which, the top 7 really represent almost 30% of the index, and it really does skew things, and as it did on the upside. So they had a good year, admittedly, but you can see the difference here that if you take out those AI stocks, you actually had a very respectable return, and you ended the year on a high note, and you had a better than average annual return just for the year. So the focus is on, I think going forward is really trying, what can we do to mute this volatility out here? Because as easy as it seems like these stocks went up in 2023, they could easily take profits and sell off, and we could have multiple contraction in 2024 where you could see, losses, 10, 15%. You've got to guard against that. All right, we've got public debt. That will be coming into the calculus as we're running fairly strong deficits in heading into the new year, and we'll see, what our dysfunctional Congress will come up with in 2024 with regard to spending and whatnot. But it's leading to a large amount of debt issuance, and we've already seen the latter half of last year that some of that debt issuance was met with kind of a tepid demand in the market, and so you're having to be more competitive on rates, and so your rates are moving. Basically you're reducing your prices, and your yields are moving higher. But this has another tangential effect, and another reason why it was in the research where I found it, and another reason why I'm putting it in here where I am, is that you've got debt levels that are rising, and it's putting, creating some challenges on investment. So you've got more supply, which, as I said, has its sometimes unintended consequences on rates, but it's going to be competing for investment dollars, and so you might have a crowding out effect with public debt. It might make it a little bit more costly for other commercial and municipal issuers to issue that debt as well. We have the Russell 2000. This is the ETF, and we've mentioned at times last year the struggles that the Russell 2000 had. You can see, here's the demarcation of 2023, 2024. It has its ups and downs, but by and large, it was, it had good points in the year. It really took it on the chin in 2022, and so we're actually not back up, and not necessarily close to where we were, before we sold off in 2022. So point to point, Russell 2000 really had a tough go of it. However, on a technical side, and the neat thing is, and I do look at moving averages, I'm not a technical analyst per se, but moving averages, I think, do tell a story. And so, in the blue line, you've got the 50-day moving average, which by its nature, if you're only averaging 50 days together, you tend to get a line that oscillates a lot more than the 200-day moving average, because you're averaging more data points. And so, from a technical standpoint, when you have the 50-day punch above the 200-day, they call that a golden cross. And that is, you can see here, going back to these instances where you tend to have, a continued follow through, if you will, on performance in the index. And I think that's where we are now. Feel like this has some staying power, unless, again, there's a complete risk off trade, that I feel much better about this environment for the small caps than I have at any point over probably the last 6 to 9 months. Another thing that we're going to be looking at in the new year is the relative valuations of international investing. And, we just, earlier in the chart pack, you saw, personal income levels expected to be positive across the globe. We know Germany is teetering on the brink of a recession just because manufacturing and its end markets have been in a bit of an upheaval for various reasons. But here, I want to show you almost a historic deviation. This is a price to earnings discount of international stocks relative to the S&P 500. And so when we talk about international, we talk about the MSCI All Country World Index ex-US. So it takes out the US component of this world stock index and it compares it with the S&P 500, looking at earnings over the next 12 months. And that deviation, again, international stocks tend to trade at a discount, about a 16% multiple discount to the S&P 500, but we are down at a 34% discount. And statistically speaking, this is like a 1 in 100 occurrence. This is a very rare instance. And I think, what we're going to be talking about in 2024 is the value opportunity for international investing as you look out maybe over the next 2 to 3 years. And so, this is a pretty eye-opening statistic. Another slide that I pulled from the Daily Shot. It's really interesting to me. So I want to kind of preface this by saying, this is looking at the next 12 months price to earnings ratio and the various themes in the market. Are they expensive? Are they cheap? Everything above this line represents something that's expensive relative to the last 10 years. And everything below the line represents everything that's cheap relative to the last 10 years. And so, we just got through talking about, small caps and, and here's S&P 400, which represents mid cap or middle size capitalization firms. S&P 600 is another, very much like the Russell 2000, represents small cap firms. These have a they're relatively cheap to the average over the last 10 years. The overall index, again, led by the Magnificent Seven, is relatively expensive. So we want to be careful about that. But, what we've been focusing in is, we've focused on value to some degree. We focused on dividend. This is momentum right here, which is okay. It's not necessarily expensive or cheap. But we have low volatility, and these are all themes that on the spectrum are not unattractive. And so I think that another thing we're going to be talking about in 2024 is, and we've already seen volatility in the Mag 7 year to date, is looking at this as a sum of its various thematic components and trying to find those thematic components that are actually cheap relative to a trailing valuation. Here's our last slide. It's more of a secular view. We talked very early about some of the struggles that we see near term in China, just trying to manage its growth. It's got a debt bubble. It's got real estate troubles, and oddly enough, you've got a government that's trying to inspire young women to have more babies, and they're actually pushing back. There's a very good article in the Wall Street Journal last week on that. But to that end, we have a number of births in China. They've so overmanaged this whole one-child policy that they're trying to desperately back away from. But it has caused a secular decline in births in China. And so, last year, I think we celebrated what most statisticians believe is the inflection point where China's population is now in net decline because of this issue. And, as we look at, China's efforts, its 100-year marathon, so to speak, to 2049 to, establish itself firmly as the global leader. This is a major headwind, and they're not importing labor, mind you, like we are. They are very, very insular, and in many respects, a closed society as we would define it. But this is going to be an issue over a longer period of time, obviously not as important per se to 2024, but certainly as we look over the next 10 years. That's all we have for this week. I hope you've enjoyed the chart pack. I hope you have a wonderful week, and we look forward to talking to you again very soon. Take care. Bye-bye.